Welcome to the Capital News. I am your host, Alex Kreitis. Today is April 23rd, 2019. Thank you so much for joining me. Whoa, Nelly! The stock market, the S&P, the Nasdaq have hit all-time highs. What's going on? So the S&P closed up 26 points for the day, closed at 2,933, setting a record, and that was up almost 1 percentage point for the day. The Dow was up 145 points and now sits at 26,656 points. That was up about a half a percentage point for the day. The Nasdaq was up 106 points and now sits at 8,120, again an all-time high. And that was up 1.3% for the day. The Russell 2000, the small cap index, gained 25 points and now settles at 1,585, which was an increase of about 1.6% for the day. The Russell 2000 still remains in correction territory, so pretty much a 10% decline from its all-time highs back, I believe it was in the third quarter of 2018. But what is going on here? Well, there were a few companies that reported some pretty solid earnings and surprised analyst expectations to the upside. Again, we have to remember the game that's being played here, because given the fact that we had a major sell-off in the fourth quarter of 2018, that pretty much prompted a lot of analysts to revise their expectations for the first quarter downward. Now, obviously, they are capable of changing their opinions and their projections at will whenever they feel necessary, but I think there was a overshooting to the downside. Again, we talk about the different types of risks, and when you have information, that when you have negative information, which we had again, according to me here at the Capital News, stock markets going down is not a negative if they are finding fair value. That's the purpose of a free market capitalistic system. Prices are supposed to clear. They are supposed to find fair value. But that's not the world we live in. So you have to understand the game that is being played. The babies threw a hissy fit. That's them on Wall Street. The Federal Reserve did a policy 180 and started to say, okay, all right, we're not going to tighten. We're not going to continue to raise interest rates. And now we're just going to be in wait-and-see mode. And that's where we have been for the past few months now. And that is likely where we will remain for the next few months going forward, if not further. So this is the game that's being played. These analysts may have overshot to the downside because of the asymmetric nature of negative news or negative events to positive events. And so now the hurdle for companies to outperform and beat and surprise to the upside, it's that much easier to jump because it's a lower hurdle, because of the lower expectations. It doesn't necessarily mean that everything is great. I mean, for some companies, there's some good news. That's to be reported. It is. Some, not so much. Some just didn't lose as much as was expected in the stock rally. So, I mean, you got to understand the game in which we are living. This is a casino. When you have so much liquidity in these markets, and some of it, again, sitting on the sidelines, perhaps waiting to get into the market, it's not going to be a surprise to see these highs being made, and they might continue to be made. Again, we've been having this conversation in regards to Larry Fink of BlackRock, saying there could very well be a melt up in the stock market. And he's referring to a lot of cash that remains sitting on the sidelines or that has been parked in fixed income because it's seen as a safer bet as opposed to equities. And if that money should come rushing into the equity market, that you could see a melt up and there could be a continuation of this V-shaped recovery that we have been experiencing for the past 4 months now. I mean, my goodness, it's already the end of April and this thing's still going. So it's going to be interesting to see what other companies come out, and there's still some big names coming. We still got Caterpillar, Microsoft, Amazon, eBay. I mean, there's a whole host of companies coming out to report, and they could continue what we saw today, and this market can continue to rally. This is just the world in which we live in. It doesn't take away from the fact that we talk about a lot of the data that points, to not such a rosy picture, but we don't have fair market value here in these markets. Unfortunately, we just don't. I mean, you're talking, again, these large 1 percentage point moves to the day. So this is volatility. Volatility to me is upside and downside, not just one way or the other, not just when it's down. It's a volatile day if it's up, it's a volatile day if it's down, that type of movement. All right, so that's something to be mindful of. Now, the Russell 2000 is an interesting character because this gain of 25 points for the day pretty much gives them back to where they were last week, because there's been some, sizable movement to the downside in the Russell 2000. We said that was something to look out for because most of these smaller companies that comprise the Russell 2000 are really United States based. They don't have a lot of business overseas. They are not geographically diversified as the companies that comprise the Dow and the S&P 500 and even a lot of the Nasdaq 100. These companies in the Russell 2000 are domestic based. So again, not a lot of geographical diversification. So we were saying, well, this is something to pay attention to, because are the small caps signaling, well, maybe things aren't as great as what we are led to believe by the president and some other people within the central banks and the White House. I mean, what's going on here? Because there's a switch. Now, what you also have to understand is when you're dealing with small caps relative to large caps, the small caps are also going to be the riskier asset group. All right, so maybe people's like, well, yeah, we want to be quote unquote risk on, but we don't want to be that risky and get into the small cap index. We just want to stay with the big boys. They're continuing to make money. There's still some, decent earnings being made. There is some top line revenue growth that still exists. Let's just park our money there. They pay dividends. Let's do it that way, as opposed to getting in all in and going in with the riskier bets, which are the small caps. Now, that could turn on a dime. Okay, this is one day. One day does not make a trend. So we have to keep our eye on this. We have to see where this money is going to go, because also today we had a rally, a little bit of a rally in the Treasury market. So again, you're starting to see sort of a decoupling here. So when you have that rally in the bond market, you have prices going up and you have rates, the yield going down. And right now we have the 10-year Treasury, which was down almost about a percentage point today, and is now sitting at 2.57%. So when you suppress these rates, people are like, well, if I'm going to put my money away, I want a return. I want something for my money. If I'm going to send it out there, it has to come back with more money. Is 2.5% enough? That becomes the question. So if you're going to suppress interest rates, or people are going to say, well, all right, it's sort of forcing me to go out further on that risk curve, which is something we talk about here all the time. This is the shenanigans that's taking place. This was the problem with quantitative easing. It suppressed interest rates. It made people get in to other financial assets, particularly the stock market. We've had the conversation. When you look at the monetary base, which is a good representation of the quantitative easing, because you see the step-like pattern of when the Federal Reserve put the pedal to the metal and basically injected liquidity. They printed money. They counterfeit money. That's what it is. It's funny money. You do it, they're going to lock you up and throw away the key. But they can do it at will. And you pay for it. I pay for it. We pay for it. And higher costs of living. This is the biggest wealth transfer in the history of mankind. This is why you have people like Ray Dalio out there saying, look, income inequality is a big problem. It's a big problem. It causes populism. It causes political strife. It causes big issues. Be on the lookout. And remember that report that came out, and we've had that conversation over the past couple of days from Ray Dalio and Company, his hedge fund, Bridgewater Associates, saying, look, it's very likely that U.S. corporations, that their profit margins have peaked, and that over time we're going to see a significant decline in the prices of equities, as much as 40%. At a minimum, I see them going down 40% at a minimum. I expect a lot bigger drop than that over the course of a year or two. Once something takes place, once there is a catalyst, once this thing starts to give way and starts to correct to a fair market value. Again, when's that day going to come? If I knew, I'd tell you. We could prepare for it. We could bet a lot of money shorting the market, but I don't have that crystal ball. I don't have that information. And as long as we remain in this financial world of Oz, where central banks the world over are continuing to put the pedal to the metal, lowering interest rates, embarking on quantitative easing or some similar program like it, this is what is likely to transpire. Do I still believe that diminishing marginal returns are going to kick in? You bet I do. Absolutely. I mean, they are not going to defy the laws of economics forever, but they can play a shell game for a little bit. And that's exactly what we've been witnessing here for the past 4 months. How much longer can they keep this going? I really don't know, but all I do know is the longer that they keep it going, the worse off it's going to be for everybody, because the higher this thing goes up, the further it can fall and the more damage it will bring with it. So let's hope that these markets can return to fair value. And again, check out my article on the Capital News. Why do we fear recessions? I mean, that's a legitimate question, because you have to look at recession being synonymous with the word correction. Corrections are good things. You're getting rid of the waste and the fraud and the abuse, hopefully, and the inefficiencies that are taking place within the marketplace. But when you have governments and central banks coming in to, quote-unquote, save the system, all you do is prop up poor behavior. That's all you're doing, because they're afraid that they're not going to get reelected, they're afraid that they're going to be blamed, and they're afraid that their little Ponzi scheme that exists the world over is going to come crashing down, and they just can't let that happen. They can't let that happen. So you and I have to be debt slaves. I hope you're not debt slaves. I mean, have as little debt as possible, because I had the conversation here yesterday in regards to, student loan debt and how now you have 2020 presidential candidates, particularly Pocahontas, Senator Elizabeth Warren out there saying, well, there's going to be debt forgiveness for student loans. You don't bail out people. I mean, where's the responsibility? You bailed out the banks. They knew they were going to be bailed out. This is the problem. When they know that mommy and daddy government and the central banks are going to come and save them, I mean, they can take as big a risk as they want. What's the problem? I mean, it's really rich to say that the Federal Reserve is a banking regulator. I mean, they don't regulate them. They didn't stop the subprime. They never admit anything was wrong. They thought the housing market was completely fine. You can go find the clips on YouTube. They still exist regarding then Ben Bernanke, the Federal Reserve chairman. Oh, no, there's not a problem in the housing market. And then, boom, that was the end of it. They don't foresee recessions. They're never going to say that they see a recession. It's not what they do. They're not going to do it because it'll cause panic. They will never admit it. Now, once these people are out of office, when they're out of the Federal Reserve, like we've had many conversations regarding Alan Greenspan, he sees the light. He says the stuff that we talk about here on the Capital News. But the likes of Ben Bernanke and Janet Yellen, they don't. They're still brainwashed. They're still stupid. They're still out there saying everything's fine. Now, is everything fine? No, it's not. But again, that doesn't mean that these markets cannot continue to make new highs, because that tends to be human nature too. People are going to be afraid of missing out, the fear of missing out, FOMO, that's the new catchphrase. Is that a possibility? Yeah, that's in complete agreement with Larry Fink of BlackRock in his melting up scenario within the stock market. That is a possibility. That is not to be laughed at, because there is money sitting on the sidelines. You have foreigners who have been net sellers. They have been leaving the U.S. markets since last year. You have pension funds who have been leaving. A lot of people are not in this market, have not, I guess you could say, benefited from this V-shaped recovery. And so now they're going to say, well, my goodness, we missed all of this, and now it's making new highs. Or, you're supposed to buy low, sell high, right? That's what we're supposed to do. Most people don't do it. That's why most people lose money when they get involved with the stock market, because by the time they get involved and they hear names on the news, the stocks have already made their big moves. The smart money's already profited big money. Now they're going to get the suckers, the retail investor, the average Joe out there, and now that's going to bid up the price even more. They'll make even more profits, and they're going to run away with profits. Meanwhile, you're left holding the bag. You bought high, and now you're going to sell low because you're like, I can't take it anymore. I'm losing 15, 20%. I can't hold it on any longer. And then you end up losing money. That is what concerns me here, because this could be one of the biggest setups in the history of the world, because it isn't just the U.S. making new highs. There's some other markets that are making highs as well. And that's likely to continue, in all honesty, because we are still in the midst of earnings season, unless there is something hugely disappointing in some of these earnings from some of these big companies that we mentioned here earlier. This is likely to sustain itself for the short term. Again, I don't have a crystal ball. I'm not going to predict day-to-day gyrations and movements, whether it's going to go up 60 points or 25 points or 1% or 3.3%. I'm not going to get into that game, but just be mindful that this is the world in which we live in. There is money sitting on the sidelines. You have central banks that are in wait-and-see mode. You have federal governments that are continuing with their stimulus programs. So anything is possible. One day the market could wake up and say, we're done with this. We don't trust all of this anymore. Diminishing marginal returns kick in. Things aren't as great. They start to pay attention to a lot of the data that we focus here on the Capital News. And it's like, oh, well, they're scratching their head. Something ain't right here. Maybe we should take some profits that we've made over the past few months, which are really record-setting. I mean, if you had just gotten involved from January 1st to today, I mean, you have one hell of a year just off of that return alone. Most people don't make that, whether you're a hedge fund, a great money manager. You just don't make that. And all you had to do was basically buy the S&P. So for this thing to go up any higher, it's, to me, starts to become a fool's rally, a sucker rally, and you really have to be careful. If you're somebody who likes to maybe trade or, be a swing trader and get involved in some options, do so if you know what you're doing, but be careful, because to me, the risk reward is not really worth it. Again, my portfolio, I'm diversified. I have precious metals. I have stocks that are long. I have some positions that are shorting this market, and I have a cash built up because I don't know when the day of reckoning is going to come, but it is going to come, and that's why you want to have some cash set aside to take advantage of the sale of a lifetime, which is likely what's going to happen. We have the conversations all the time here with how much corporate debt exists, outstanding bonds, outstanding commercial and industrial loans, the leveraged loan market. I mean, it makes your head spin when you look at these numbers. So be mindful of all of this. But the market is an emotional machine. It's not all logic. It's not all common sense. It's not all hard data. It's very emotional. It's very behavioral. So that's the things you have to pay attention to. So don't be surprised if we do have more of a melt-up. I honestly believe that we are already basically in that type of environment with a melt-up, because you don't see a lot of V-shaped recoveries in history, especially not to this extent. A lot of people out there who have a bearish tint on the market still believe that we are in a bear market. I believe we're still in a bear market, but they're saying that this is a bear market rally, which, if you look historically, a lot of bear market rallies do tend to be rather sizable. So that is at least consistent, but it doesn't mean that this thing can't go higher, and it's likely to. Again, pending bad news from some of these other big companies given Q1 earnings, or some sort of, black swan event regarding the oil markets, particularly, maybe something coming out of there. And we had that conversation briefly yesterday because the Trump administration is lifting the waivers regarding countries who have been importing Iranian oil. They're saying, nope, game over, can't do it now. Now you got to go get the oil somewhere else. That drove oil prices up. Where are we at now? We're at $65.89 on WTI, and I think when it comes to Brent, give me a second here, I'll look that up real quick here. Brent right now is at $74.30. So that ain't cheap. And if you're putting gas in your car, the price of gas is going up too. So now we're going to have to do that dance. Trump wants to play tough guy with Iran, but now he's going to have to also deal with higher oil prices and higher gasoline prices, and that was something that he was fighting pretty hard last year. So we'll see how he turns up the heat on OPEC and Russia, more or less on OPEC, primarily Saudi Arabia, to keep the pumps pumping. Now, I don't anticipate Saudi Arabia to reverse course. I just don't, especially not most of OPEC. And again, we have the other issues in Venezuela and Libya. So it's going to be interesting to see what Iran does, but we're going to pay attention to it because you could have another spike up in oil prices should the Iranian Navy and military decide to say, you know what, we're going to shut down the Strait of Hormuz, where a lot of the world's oil must travel through to get to the other global markets. That's just a fact of it. I mean, look it up on a map. It's a tight fit, basically, when you're looking at it, and it is very important for black gold to be transported around the world. What will happen? Stay tuned because it's interesting. Gold has hit a 4-month low, now sits at $1,272 an ounce. Silver is also down for the day and sits at $14.77 an ounce. So quite the downturn there in the precious metals markets, I should say. The VIX was only down 1 percentage point today and now sits at $12.28. Now, let's go way across the pond, because this is something that we have to pay attention to, because this goes with the general theme, I believe, of more central banks that are going to be coming online to either be wait and see or perhaps cut interest rates. And who am I talking about? Well, I'm talking about the land down under, our Australian friends out there. Hello. So inflation came in lower than expected down under. So what does that mean? Well, it means that gives the central banks a window, if they so choose to say, all right, well, we're going to keep interest rates low, which is basically a given. They're not going to increase them. Or perhaps we're going to cut interest rates. All right, that's a possibility with Australia. But that's where we stand right now with them. I happen to believe it's definitely going to be, at the very least, it's going to be wait and see. The Reserve Bank of Australia, they will say we're at least going to be in wait and see mode moving forward. Perhaps they'll cut them, because Australia, their inflation target tends to be about 2 to 3%. Here in the U.S., we really try to target 2%, but Australia, 2 to 3%. So they just had a 1.3% read. What's going to happen? Well, if they really want to prime the pump, they could go do so. And they could lower interest rates again. And they're basically running right now at record low interest rates in Australia. So it's going to be interesting to see what happens there. As far as the Forex markets are concerned, the currency markets, the Aussie, the Australian dollar, has just been getting walloped. It's down almost a full percentage point against the U.S. dollar right now as we speak. And again, folks, for those of you who aren't aware of the currency markets, when you have just a penny move, downside, upside, that is a huge movement in the currency market. It's a very interesting market. I think it happens to, well, again, it's like anything, but I think fundamentally speaking, because the currency market is the most liquid market in the world, it tends to better follow the fundamentals of an economy as opposed to the stock market. My opinion, my experience, especially where we sit right now. And when you look at the likes of some other investment legends, such as a Stanley Druckenmiller, a hedge fund legend, basically making 30% returns for, I think, 30 years, is basically out of the market now. You have Bill Gross, an investment legend, king of bonds. He's retiring because a lot of the metrics, a lot of the signals that these guys used to look at, that they bet big money on, when they do so, they're losing money. This goes to the whole thing that we're always talking about here, that the markets are becoming more and more disjointed. They are not connected to the fundamentals of their economies, of their respective economies, whether we're talking about the U.S. markets, European markets, Asian markets. It makes no difference. There is a disjoining, and this has to go to the fact that we have central banks and federal governments printing money and embarking on stimulus programs the world has never seen before. And when we had our correction in the starts of it back in the fourth quarter of 2018, they said, "Whoa, Nelly, something's amiss here, because we've been doing all of this stimulative stuff and it's not working. Why is this going down?" It's because the markets were trying to correct. They were trying to find fair market value. That is what they are supposed to do. When you have governments and central banks intervening, we no longer have a free market capitalistic system. And that in and of itself is a true crime. So stay tuned, everybody. There's going to be some interesting news coming out this week regarding the earnings report. So stay tuned. Are we going to make new highs off of this information? The Dow is only a couple hundred points away from touching its all-time highs from last year. Will it do it this week? Stay tuned. Thank you so much for joining me, ladies and gentlemen. It's been a pleasure having you. As always, please like, share, subscribe, get the word out, leave your comments. We would love to hear from you. This is the Capital News. I am Alex Karitis. Godspeed.